So as a Canadian, you have access to certain types of investment accounts. In today's video, I'm going to go over the 3 different types of investment accounts, how they impact you, and the optimal order of investing that you should consider. If you're new here, hello, hi, my name is Alice. I'm a chartered professional accountant. On this channel, we discuss personal finance, digital marketing techniques, and some other life improvement stuff. So please do me a favor, thumbs up, hit the subscribe button, turn on that notification bell, and let's get right into it. Now, there are 3 main types of investment accounts. The first is tax-free accounts, the second is tax-deferred accounts, and the third is taxable accounts. So let's start with level 1. This is also called your TFSA in Canada. If you're in the States, this is similar to a Roth IRA, not 100% identical in nature. There are some nuances, but generally speaking, the idea is the same, and that is the account and all of the investments that you earn from the account are tax-free. So let's say that you invest $1,000 into a tax-free account and that account grows at 5% every year. By the end of year 1, you would have earned $50. That $50 can be pulled out at any time tax-free. If you invest that $1,000 into stock and it goes up by 20% and pays you a 5% dividend, the $200 appreciation would also be tax-free, as well as the 5% dividend. So the premise of a tax-free account is that your contributions and your earnings grow tax-free. You can put any marketable security, GIC, stocks, bonds inside a TFSA. Now in Canada, as of January 1st, 2024, you can contribute a maximum of $95,000. So if you've never contributed to a TFSA before and you were over the age of 18 in the year 2009, which is when the government announced the TFSA, then you have a lifetime contribution amount of $95,000. The Canadian government sets an annual contribution limit. In 2024, this contribution limit was $7,000, and they will adjust this every year based on inflationary factors. Now, last year, the Canadian government introduced a new type of account called the FHSA, also known as the First Home Savings Account. Now, very similar to a TFSA, your FHSA allows you to pull out money tax-free. The only caveat is that money must be used to purchase a home. If you don't use the withdrawals to contribute to a home purchase, then that money will be taxable to you in the year that it's withdrawn. So back to the same example. So if you invested $1,000 into an FHSA, it grows by 20% and it pays you a 5% dividend. The $200 that you make off the investment plus the $50 of dividend income can be pulled out tax-free as long as you use that money to contribute to your first home purchase. If you decide to pull that money out or you need to use that money for other things and you do not use that money on a qualifying purchase, then that $1,250 will be added to your taxable income. This account was introduced by the Canadian government in 2023 to assist people with first-time home ownership. If you don't own a home and home ownership is one of your main goals that you're working towards and you know that you will use the money for a home, then start with the FHSA. If you already own a home or home ownership is not one of your financial goals, then the TFSA is what you want to maximize first. So it's important that any money that you contribute to your FHSA actually is used for home ownership and not just used for tax deferral purposes. It's intentionally designed to be that way so people are not double dipping on the tax-free advantages to the FHSA if they don't intend to use the money for a home. If you want to pull your money out of the FHSA without any tax consequences, there are a few options that are less common. The first is to transfer that money into an RRSP. The second is to do a direct transfer. So if you held that $1,250 in a registered FHSA account with RBC and you want to transfer that $1,250 into a registered FHSA with Wealthsimple or BMO or TD, then that would not be taxable, of course. You can also do a designated transfer, which is a less common scenario. Now, the FHSA is a relatively new account. It is not applicable to everyone. So if you already own a home, then you will not have access to an FHSA. The final thing I'll say about tax-free accounts, which is the TFSA and the FHSA, is that you can generally invest in any sort of marketable security under that account. So this can be any form of interest-bearing investment, GIC, bonds, mutual funds, or it can be stock, which pays dividend income, an ETF or index fund. Now, the level 2 account is known as the RRSP, or the Registered Retirement Savings Plan. plan. For most people, the RRSP is the most important investment account that they will have. So when people talk about saving money for retirement, letting that money grow over time with the market, it's in the vehicle of the RRSP. And if done properly and maximized every year, that account does have the ability to grow into the 7-figure range. If there's any one takeaway that you can get from this video, it's the RRSP. The RRSP is the only way in Canada that you as an individual can materially lower your tax liability at the individual level. Now, there are some smaller things here and there. Government introduces certain credits, benefits, deductions that apply to people in certain scenarios, but the RRSP is the only actual vehicle that can materially, in the thousands, reduce your tax liability. If you are an accredited investor or you have a corporation, you may lock more advanced tax planning solutions, but regardless of your situation, it doesn't matter. At the individual level, which impacts all Canadians, everyone should have an RRSP and they should be maximizing their contributions for their RRSP to reduce their tax liability. If you ask your accountant, how can I lower my individual tax liability every year and pay less tax? The answer is to buy RRSPs. So the biggest benefit of the RRSP is that it reduces your taxable income during the year for the amount that you contribute. If you make $100,000 and your contribution limit is $18,000, you put that $18,000 into an RRSP, your taxable income goes from $100,000 to $82,000. So you've lowered yourself into a lower tax bracket for the year. You will get a tax refund by $18,000 multiplied by your effective tax rate. If you are interested in learning more about marginal tax rates and tax brackets, I'll leave a video up top here for you to check out. And whatever you choose to invest in with that $18,000, whatever money you make off that will be tax deferred, so you will not be taxed on it until you decide to pull the money out. So if you make any withdrawals out of your RRSP account at any time, it will be taxed in the year of withdrawal. So 5 years down the line, whether that $18,000 has grown up to like $25,000 or it's kind of stayed stagnant depending on the market, whatever amount that you choose to pull out at that time will be added to your taxable income. So in year 5, if you pull out $5,000, $5,000 will be added to your taxable income. In year 5, if you pull out $30,000, $30,000 will be added to your taxable income. So in both scenarios, both the capital gains and the dividend income is all tax deferred, meaning that you don't pay tax until you pull the money out at a future date. So if we put this all into perspective, what does this mean for you when it comes to your RRSPs? Well, the first thing is that you have to think about the timing of your withdrawals. The biggest benefit to an RRSP account is that when you contribute during your peak earning years and you're paying tax at the higher income brackets, you will be able to get a much bigger tax deduction when you're retired or in a year where you're earning less income and you're paying tax at the lower tax rates. So the discrepancy between the higher tax bracket during your peak earning years and the lower tax brackets during lower earning years or retirement years, that's where the benefit of the RRSP account comes into play. So in your peak earning years as an adult, if you're paying around 30% effective tax, the refund that you get is much bigger than the amount of tax that you have to pay when you're retired. So maybe later down the line, you decide to scale back from work, you go part-time, you get ready for retirement, and your income is lower in the future years. You are then paying tax at a lower tax rate than in your prime earning years. It's the discrepancy between the two tax rates that's where the benefit of the RRSP comes in. If you need to pull money out of your RRSP before retirement, it's a good idea to time the withdrawals so you're pulling money out in a year where your income is lower. This RRSP is applicable to everyone in Canada, but this is critically important for high income earners or business owners that are paying tax at a very high bracket, especially during their prime earning years, because the best thing that you can do during those years is to buy RRSPs. If you have a business and you're wondering how much of a salary that you should pull out of your business to maximize your personal tax situation, what you want to do is you want to take the annual limit, which is $31,560, divide that by 0.18. So that means RRSP benefits in general are capped when your salary is about $175,000. So you want to pay yourself $175,000 salary and use all of the after-tax money to invest into your RRSP account. Now, the CRA has a fancy calculation of how much you can contribute to your RRSP account every year. The CRA will do their own calculation on their back end to tell you what your limit is, and this is a calculation that they do based on earned income, pension adjustment if it applies to you, as well as the annual limit that they set every year. The calculation is roughly 18% of your earned income for the year. So easy math, if you earn $100,000, then your annual contribution would be $18,000. They will make this calculation based on earned income every year, which is income from employment or income from self-employment. They then compare that to the annual limit, which is set by the government. In 2024, it was $31,560, and they will take the lesser of the two. Now, the good thing about RRSPs is that your contribution limit does carry forward. So in the prior year, if you made $100,000 and you had an $18,000 contribution limit increase and you did not use or maximize that $18,000 limit, you can carry that balance over to the next year. If you've never contributed to an RRSP account before, don't worry, you're not missing out on any of the tax benefits or the tax deductions. The only thing that you're missing out on is the ability for your investments to grow at a tax deferred rate. So once you've maximized your FHSA, if that's applicable, your TFSA and your RRSP, which both of those numbers go up every single year, then you can look at taxable investment accounts. Why is it called taxable? Because there are no tax benefits to this account. So if you're doing any form of your own investing, make sure you've maximized both your TFSA and your RRSP and the FHSA if it applies to you and you want to do it before opening up a taxable investment account. If you're working with a financial planner or an investment advisor, they should be trained to know these things, but always ask and make sure. The only time you might accidentally make a mistake is if you do your own investing and you open your own self-directed brokerage account and you accidentally select a taxable investment account when you're opening your account. Now, let's also talk about cash flow planning for a second, because when you put money into an RRSP, you do have to part with that money and be okay with not having access to that money because of the tax consequences. So for example, if you predict that your income is going to be high for the next couple of years, but your liquidity is also going to be low, in other words, your cash flow is going to be tight, then you might want to consider actually holding off on the RRSP. But if you're gonna be okay with parting with that cash for a while, then it's wise to buy the RRSPs. If it's done properly, the RRSP is the one account that I have seen many people grow into the 7-figure range. The FIRE movement, financial freedom, it's using the RRSP account or the tax deferred account as a vehicle to achieve that. The general optimal order of investing for most people is first the TFSA, then the RRSP before going into a taxable account. And if you haven't purchased a home yet and that's on your plan and something you want to do in the next few years, then the FHSA is where you want to start. If you like this video today, I think you're going to like another one of my videos in my Accountant Explained series, which is the blueprint to building financial freedom and generational wealth. So make sure you check out that video up top. I think you're gonna love it. I hope this video gives you some good food for thought, allows you to think about your finances and tax planning. If you found any value in this video, please do me a favor, like, subscribe, turn on the notification bell, and I'll see you guys in the next one. Until next time.